But the big, the development, the big headline is that India is going to get added to the JPMorgan Global Bond Index. Now, this is a big milestone. India was the only large emerging market which was not a part of any emerging market bond index. We've been on a watch list for a long time. We've been waiting for quite a while. And finally, Latha, this has happened. So take us through the implications for the news, the implications for bond currencies and even banks.
Okay, well, for starters, the numbers itself, the index into which India gets included is called the GBI-EM GD, which is the Global Emerging Market Index, Global Diversified. That's what that GD means. Now, 330 billion of Indian bonds become eligible, but that doesn't mean all of them, of course, will be bought. The weight of the index, this GBI-EM GD index, the total amount of bonds benchmarked to it is 236 billion. And currently, it accounts for 213 billion in terms of market cap. Now, India gets a 10% weight of this, which will start from June 28, 2024, with 1% getting added every month. That is so that it is non-disruptive. So, if we are going to get 10% of a current 213 or an eventual 236 billion getting benchmarked, it is an approximate 21 billion, if you take it conservatively, when the entire 10% comes in. So 1% a month will mean 2 billion become eligible. At the entire 10%, it'll be, somewhat 21 billion will be about 1.8 lakh crore. Now, every year, the Indian government issues fresh about 4 lakh crore of Indian bonds. So next year itself, it's going to be very good for the government that comes in, because you're going to see a big buyer come in, and therefore the bond yields will fall. Now, what happens today itself? Chances are that today we are going to see an initial reaction which will be positive and bond yields will fall. But given that the Indian market has not reacted to 4.5% US 10-year yield, so that's a huge counter negative that comes in. We will have to see, because yesterday when the US bonds went from 4.23 to 4.33, we didn't budge. So a part of that is already in the price. So today at 4.5, will we still not budge? We will have to wait and see. I'll defer to the experts when they join us. But nevertheless, chances are that there will be some bit of bond gain for banking stocks, because this comes very close to September 30, very fortunately. So the mark-to-market gains are likely to be there. And so there, I would think, be some kind of a rally even in the bank stocks. But overall, this is a positive macro, because if the sovereign pays less for their loans, for her loans, all corporate bonds are benchmarked to it. The best AAA bonds will be about 20-30 basis points higher in yield compared to the sovereign. If the sovereign is paying about 7% for their borrowings, then you are going to have a lower cost for corporate India. Therefore, highly leveraged companies, probably metal companies and such like, Nigel, you'll be better placed, should also see some advantage. Now, I am at a loss as to how much of the gain will show in today's market, because the circumstances are so adverse. But in the long run, this is a concrete EPS positive, EPS accretive news, starting June, of course.
So cost of capital, cost of borrowing goes down, and it also brings in the much-needed depth in the bond markets, right? So we'll, of course, talk about that. Thanks a lot, Latha. We'll get many experts to join us in the next couple of minutes, so don't go anywhere.
There's a bit of currency rub-off as well.
Currency appreciation is what
there is less depreciation because of the strength of the US dollar. But I must say that today, there are 10 other factors weighted against all this.
There's this overhang of negative global cues. I take that point. And of course,